So moving on to section B then, we've now got what we call the optional questions. So there are 5 questions in here and you are required to do only 4. So there's not a lot of choice, but there is a choice to a limited extent. And this makes up 40% of your paper. So each of the 4 questions are going to be worth 10 marks. So they're going to be smaller questions and basically on other topic areas that you've not already done in section A. So on this exam, we do try to cover as many of the topics as possible, even though they might be worth less marks. So let's have a look what question 3 is first of all. So question 3, if we go down to the requirements, this is a capital gains question. So for 8 marks, we've got to calculate the gain. It's not asking you to work out the tax. So always read the question carefully. Do they want the tax or do they want the gain? Because if you carry on working out the tax, you're going to waste time on something you won't get any marks for. And then part B is another very short explanation to do with one of these properties. How would it have been different if she returned to live in the property as her main residence and remained there until she sold it? So we'll look at what that is when we get to it. So let's do the main part first of all, then the capital gains. So as quite common in a capital gains question, you have a number of transactions, and for each one you've got to work out what the gain should be. So if we start at the top, then we've got a painting. Now hopefully you remember from when you did it in class, a painting is something we recognise as being a chattel. So you've got to think about those chattel rules: tangible, movable, property. So it's a chargeable chattel. It was originally bought for £3,500 and it was sold for £6,500. So if you remember your chattel rules, if you buy and sell it for less than 6, it's exempt. If you buy and sell it for more than 6, then it's chargeable in full. And if you've got one figure above and one figure below the 6,000, then we've got those special rules. And that's what we've got here that we're going to have to look at. Next one is some land. And it's a typical land question in that you originally bought 6 acres of land and she's going to sell half of them. Now remember, with land, you can't just assume that each acre has got equivalent cost. Yes, each one was bought for 5,000 each, so the total cost was 6 lots of 5,000. So yes, she did pay 30,000, but when you come to sell it, certain acres might have a greater value. So you can't prorate it just based on the size. So at the time of sale, the remaining acres were valued at 20,000 in total. So I'm selling it for 80. I'm selling some of that original cost and I've got some left worth 20. So this is what you've commonly done in class called a part disposal. Whenever you deal with land, I'd always look to see if you're dealing with that because it's quite common in an exam. We've got another chattel for number 3 then, and we've got an antique vase. This one was inherited from her aunt. Her aunt originally paid £500 for the vase. At the date of death, it was valued at 10,000 and she sells it for 12,400. So that's her proceeds. The question is, what cost are we going to use? But if ever you inherit something, remember you're getting it for free, so you didn't pay anything for it. But in terms of capital gains, it will be calculated based on what we call the probate value, and that is what it was worth at death. So that's the cost that you're going to use, which is deemed to be the probate value at the date of death. So you ignore the original cost by the person that's died. And then the final one is about a property. So she sells a house. She originally bought it for 90,000. She lives in the property till March 14, where she moves into a partner's property and she sells it for 194,000. Now, if it's a main residence for the whole period of ownership, then we just say the property is exempt. But as we can see here, she's lived in it until March 14 and then she's moved out. So we've got to think about that principal private residence relief to see what proportion is and isn't going to get chargeable. So we need to look at each of these in turn. So make sure you always show your workings clearly so that the examiner can see where all your numbers have come from. So the first one we've got on the list is the painting. So we start with the basic calculation, which is your proceeds less your cost. So she bought it for 3.5, sold it for 6.5. So if it were just a normal asset, she'd have a gain of 3,000 to pay tax on. However, because it's a chattel, and as we've said, she bought it for less than 6,000, but she sold it for more than 6,000, then we've got that chattel test. So the chattel test is the maximum is 5/3 of the proceeds minus 6,000. So how much did you sell it above the exemption limit? Calculate 5/3, and that will give you an answer of 8,333. So if the gain is less than that, then you'll take the original gain, but this is the most you can be charged for. So I'm going to carry that across into my total column, and that's what she's going to get assessed on. So even though the actual gain is 3,000, she's only going to get taxed on the 833. Now the land was our part disposal, so we can start off with the easy bit, which is the proceeds. Right, and if you can't do all the questions, just fill in these easy figures. You will get marks for putting some of these numbers in, so just do the bits you can. Now we want to know what the cost is, and the original cost we've said is 30,000 because she bought 6 acres and each one was £5,000 that she paid for it. Now she's only selling half of those acres, so she sells 3 acres. So you might be tempted to take half that cost, but the part disposal rule is that you multiply the total cost by the proceeds divided by the proceeds plus the market value of the remaining land. So the actual proceeds of the 3 acres she sold is 80. And if we look at the question, it tells us that the remaining acres that she's got left were valued at 20,000 in total. So we're going to put that in our formula. 80 over 100 multiplied by 30,000 gives me a cost of 24. And that gives me a final gain of 80 minus 24, which gives me 56. And if you were asked what the remaining acres cost will be, well, it'll be the rest of that 30, won't it? If I've allocated 24 here, then the other 6 of the cost will be allocated to the next disposal. Then we've got the antique vase. So proceeds we're given 12,400, and then for the cost, remember we're using that probate value, which was the 10. So not the cost to the original person that bought the asset, it's what it was worth when you inherited it, which gives me 2,400. And the final one, which is the house. Now this one's going to take a little bit more working out, but let's do the basics first of all. So she sold the house for 184, and the original cost was 90,000. So the original gain is 94,000. Now, if that had been an investment property, then that would be the end of it. If she'd always lived in the property as her main residence, then that would have been fully exempt, but she didn't. So we need to have a look at what she's doing in the property. So let's have a look up here. And in fact, let's do a little timeline to show what's going on in this property. So she originally bought the house in April 2000, and she's going to sell the house in March 19. So the first thing we want to do is calculate how long she's owned that property from when she bought it to when she sold it. And what we've got there is 19 years exactly. And if we multiply that by 12, it gives us 228 months. It's usually easy to convert these into months because of how we have to calculate everything. Now, if we look at when she lived in the property then, so she bought it in April 2000 and she lives there until March 14. So that's a period of actual occupation. So if she lives there, then that means it's exempt from tax. Let's write this down. Actual occupation. Okay, if you work that out of how long she's there, she actually lives there for 14 years. 14 years converted into months gives me 168 months. Now, she has no actual occupation, does she, after that? Because she moves out, as it says there, and goes to live with her partner. So she never moves back in the property, but we're always given the last 18 months. So regardless of what we're doing, we'll get the last 18 months if we're not living there. So the exempt proportion is going to be 186 months. Okay, she can't have this bit of time here because she's absent. We won't get it as absent any reason, because absent for any reason has to be followed by some actual occupation. Because she never moves back in, she won't get that period. So 186 months out of the ownership period of 228 is going to be exempt. So let's calculate that then. So PPR will be the gain of 94,000. We're going to have, what have we got? 186 months out of 228 months of the gain. All right, remember, that's what is exempt. That's the exempt proportion. So we're going to say 76,684 of that is exempt, and the balance of that gain will be chargeable for the period when it was sitting empty. So finally, we're going to add up our total gains for the year. And that gives us the end of that question. But always read to see if they want you to carry on work out the tax. So then you might have to think about annual exemptions. You might have to look at what tax band they're in, etc. But that's the point where this question ends. Now, part B is only a couple of marks, but what it does ask you is how this would be different. So how what we've done here with this property would be different if she had returned to the property, remained there until she sold it in March 19. So not maybe moved in straight away. Right, if you look at the date, it said what would it be if she moved in April 17. So she'd have moved in somewhere around about that period. So what would have happened is this time frame here, that would have been classed as deemed occupation under the rules of any reason, which is a maximum of 36 months. And the reason she can claim that, and she can't claim it in the current scenario, is because if she moved back in, the deemed occupation will be followed by, and previous to it happening, basically being sandwiched, isn't it, between two actual occupations. So even though she was absent for that period of time, that 36 months would still be classed as exempt because she lived there before and she lives there after. Whereas in the current situation, as it says here, she moves out and never comes back. So if she doesn't come back, then she'll never get that deemed occupation. So the answer to B is that she would have had the deemed occupation, and therefore all of the gain would have been exempt if that had been the situation. So she could have saved herself the tax on that 17,316.